If you're a federal employee within 5 years of retirement, these 3 TSP mistakes can cost you tens of thousands of dollars in extra taxes. If that's you or your spouse, stick with me here for a few minutes because these are the things I see over and over again in real plans. If this is your first time here, hi, I'm Tom, a fee-only retirement planner, and here's what I'll go over today in this video. First, why treating the TSP like a checking account in retirement backfires. Second, how your TSP withdrawals stack on top of your pension and Social Security for taxes. And third, what happens when there's no written plan and RMDs kick in at 73 and completely blindside you. So let's set the stage. In retirement, most FERS employees have 3 big income pieces: your FERS pension, your Social Security, and your TSP plan. The pension is mostly taxable. The traditional TSP is fully taxable when you take money out, and Social Security can be up to 85% taxable depending on what else shows up on your tax return that year. All of that gets piled together and the IRS looks at that total amount. Now, the first mistake that I see is when you start treating your TSP like a checking account. Let's say you retire, you need a new car, you want to redo the kitchen, maybe help a grandchild out, and you think, well, I've got plenty of money in my TSP plan. I'll just pull 40 or 50 grand this year and deal with it later. What we need to understand is that whole number lands on your tax return as income. So instead of a nice, steady, predictable income, you've got these big spikes from these large distributions. And those spikes can push you into a higher tax bracket for the year. They can make more of your Social Security become taxable, or in some cases, push your Medicare premiums higher a couple years down the road. So you could do everything right for 30 years building your TSP and then accidentally tip a big chunk back to the IRS just because of how you took the money out. So rather than thinking of your TSP as a checking account with a bunch of money in there, start thinking of it as part of your coordinated income plan. And sometimes that means strategically spreading out those larger expenses over several years, or taking some partly from Roth or partly from cash instead of one giant hit to your TSP. Now, the second mistake is not knowing how everything stacks together for taxes. So let me walk you through a very simple example. Let's say your first pension is about $40,000 a year. Between you and your spouse, Social Security is around $30,000. Now, on paper, you might think, okay, that's 70 grand. If I take another 20,000 from my TSP, I'm now at 90,000, no big deal. But behind the scenes, that extra TSP withdrawal is what makes more of your Social Security taxable because you're stacking income on top of more income. So a withdrawal that feels like, I'm just taking an extra 20,000 can actually move a big chunk of your income into a higher bracket and increase how much of your Social Security is taxed. So before taking a large withdrawal from your TSP, ask yourself, okay, if I take this out this year, what does it do to my tax bracket, my Social Security, and my Medicare? Will I push myself into a higher tax bracket? Will I increase my taxes on my Social Security benefit? A 5-minute look at that ahead of time can save you hundreds and thousands of dollars over a decade. And if you don't know how to do that and want some help, click the link below the video and learn how you can get your very own federal retirement blueprint using your numbers so you can retire from federal service without guessing. Now, let's move on to the third and final mistake: having no withdrawal plan, which leads to RMD shock at 73. Here's how this works. Under current rules at age 73, the IRS basically says you've had a nice run, now you have to start taking money out of your traditional accounts. Those are required minimum distributions from your traditional TSP. It's forced out, it's fully taxable, and it stacks on top of everything else you've got coming in as income. If you don't draw down your TSP strategically in your 60s, you can wake up at 73 with a very large balance and large forced withdrawals. That's when people are left wondering come tax time, why are my taxes suddenly so high? Or why did my Medicare premiums jump? That's what's called RMD shock. A written plan says, okay, in my early 60s, how much can I take out each year at a reasonable tax rate to control the size of my TSP by the time I hit 73? So I'm not forced to withdraw these large amounts and pay all this money in taxes. So what does this all actually mean? If you're 5 to 10 years from retirement, this is the window to shape your tax picture. Not the year after you stop working, not the year you hit 73. Ideally, you'd want to give yourself several years before retiring to plan for all this. Now, if you're already retired, the question changes and becomes, how do we clean this up going forward so the next 10 to 20 years are more efficient than the last one? So here's a few practical steps you can actually take. Write down your expected pension, your planned Social Security ages, and your current TSP balance. Figure out what you really need after tax to live the life you want to live. Before you take a withdrawal, look at what that does to your tax bracket, your Social Security, and your Medicare bracket, and put it in writing. Which accounts which you'll pull from, in roughly which order, in your 60s and early 70s. Even a one-page written plan is better than guessing each year. At the end of the day, it's not just about growing your TSP as much as possible. It's about how much of it do I actually keep after taxes for as long as I live. So if you're a federal employee within 5 to 10 years of retirement and you want a written plan that fits your pension and your Social Security, use the link below to schedule a federal retirement planning call. We'll look at your numbers, we'll lay it out on one page, and you'll walk away knowing exactly how to avoid these 3 mistakes. Otherwise, if you're having trouble deciding whether to add Medicare Part B on top of FEHB, I'd encourage you to watch this video right here, and I'll show you how FEHB coordinates with Medicare in retirement. So click here to watch, and I'll see you over there.